When it comes to taxes, most people are familiar with the basics: income, property, and sales taxes. However, the U.S. tax code is vast and complicated, and many individuals are surprised to learn that a variety of things they didn't expect are subject to taxation. Whether it's a hidden perk from work, a hobby, or even a seemingly minor item, certain assets and income streams are taxable under U.S. law. In this video, we will explore the top 10 things you didn't know were taxable in the U.S., helping you stay informed and avoid unexpected tax bills. 1. Frequent flyer miles and travel rewards. Many people accumulate frequent flyer miles and travel rewards points through their credit card usage or travel habits. While these rewards aren't usually taxed when you earn them, the value of any travel rewards you redeem could be taxable. For instance, if you redeem miles or points for flights or upgrades that have a high market value, the IRS might consider this as taxable income. The key factor is whether the rewards have a cash equivalent value that could be used for goods or services. 2. Bartered goods and services. Bartering is an age-old practice where goods or services are exchanged without money. However, the IRS treats bartered transactions as taxable. If you trade services or items, e.g., haircuts for plumbing services, you are required to report the fair market value of the goods or services received as income. For example, if you exchange a vintage guitar worth $500 for a service, you must declare that $500 as income. Both parties involved in the barter are responsible for reporting the transaction. 3. Unclaimed lottery winnings. It may sound surprising, but if you failed to claim your lottery winnings within the designated time frame, the IRS still expects you to pay taxes on that money. If you won a significant amount but didn't cash in the ticket, the IRS could view it as income you've earned. While your winnings may eventually go unclaimed by you, they are still taxable and must be reported on your tax return if you have already cashed the ticket or if you had a claim that was subsequently lost. 4. Student loan forgiveness, under certain conditions. Many students with loan debt hope for their loans to be forgiven, and under specific programs, they can be. However, depending on how your loan forgiveness is structured, you could be taxed on the amount of debt that is forgiven. For instance, forgiveness programs like Public Service Loan Forgiveness, PSLF, generally do not result in taxable income. But if your loans are forgiven through income-driven repayment plans, that forgiven amount could be treated as taxable income by the IRS. 5. Homeowners insurance payouts. Homeowners who receive an insurance payout due to damage to their property may be surprised to learn that some portions of these payouts are taxable. If you receive a payout that exceeds the adjusted cost basis of your property, essentially the value of the property after improvements, then you may owe taxes on the difference. This is particularly true if the money is used for non-repair purposes or if you sell the property after receiving the insurance payout. It's important to keep detailed records of home improvements and insurance settlements to help determine tax liability. 6. Gifts and inheritances, under certain conditions. While gifts and inheritances are generally not taxable for the recipient, there are exceptions. For example, if you inherit an asset and later sell it for a profit, you may be required to pay capital gains tax on the appreciation in value. Additionally, if you receive a large gift that exceeds the annual exclusion limit, currently $16,000 per giver per year, you may be subject to gift tax. However, it's the giver, not the recipient, who is typically responsible for paying gift tax. 7. Prizes and awards. Prizes and awards may seem like pleasant windfalls, but they are taxable just like ordinary income. Whether it's a cash prize from a contest, a gift card from a corporate giveaway, or a trophy with a monetary value, the IRS considers these winnings taxable. The fair market value of the prize is included as income, and it is taxed accordingly. Certain exceptions apply for awards given for specific achievements, e.g., the Nobel Prize, but most other prizes require you to report the amount on your tax return. 8. Unemployment benefits. Unemployment benefits are another source of income that many people forget to account for when filing their taxes. In the U.S., unemployment compensation is considered taxable income by the IRS. While these benefits provide financial relief, you must report them on your tax return. Depending on your total income and tax situation, unemployment benefits may increase your overall tax liability. 9. Social Security benefits, under certain conditions. For many retirees, Social Security benefits provide an important source of income. However, depending on your overall income, a portion of your Social Security benefits may be taxable. If you have other sources of income, such as pensions, savings, or investments, the IRS could tax up to 85% of your Social Security benefits. It's important to understand the thresholds that trigger taxation on Social Security benefits, especially for retirees with additional income. 10. Hobby income. Hobby income is income earned from activities you do for fun, such as selling crafts on Etsy, photography, or even pet sitting. While you don't need to pay self-employment taxes on hobby income, the IRS still requires you to report it on your tax return. This is true even if you don't consider the activity a business. The income you make from hobbies is taxable, but you can deduct expenses related to the hobby if they exceed your income. However, the deductions may be limited and cannot exceed the amount of income you generate from the hobby. The U.S. tax code covers a wide range of income streams and assets, many of which people don't realize are taxable. From travel rewards to hobby income, the IRS has rules that govern a surprising array of activities. It's essential to be aware of these lesser-known taxable items to avoid potential tax liabilities or penalties down the line. As tax laws can be complex and subject to change, consulting with a tax professional is always a good idea to ensure that you're compliant with the latest regulations and are not missing any important deductions or credits. Staying informed is the first step in making smarter financial decisions and protecting your hard-earned money.